I think that, people think about the Nasdaq 100, right? So the innovation, right? They want to be extremely specific companies, part of the Nasdaq 100. And then we're starting to see the Nasdaq 100 use a bit more as core holding.
All right, joining me will be Travis Spence, Global Head of ETFs at JP Morgan Asset Management, who is now up to 70 ETFs, nearly $240 billion in assets, including about $41 billion in inflows so far this year. $41 billion. That's third best out of all ETF issuers. And if you look at just actively managed ETFs, they're actually number one in inflows this year. And of course, there are some huge success stories here with the two premium income ETFs, JEPI and JEPQ. They also have the JP Morgan Ultra Short Income ETF, ticker JPST, which that continues to see a lot of investor interest. Plus, they have several new launches as well, which have done excellent. So as a matter of fact, the JP Morgan Mortgage-Backed Securities ETF, ticker JMTG, that just launched in June. It's already nearing $6 billion in assets. It's one of the top ETF launches over the past 2 years. I mean, I could keep going here. They have an active high yield ETF, which launched in June and immediately raised over $2 billion. The bottom line is that JP Morgan's ETF business is absolutely cooking right now. And so Travis and I will have a full conversation around that and how he sees their business evolving moving forward. Now, later, I'll be joined by Jillian DelSignore, Head of Retail and Wealth Distribution Strategy at Nasdaq Indexes. And I'll have her explain this, but essentially her role is to help support investment products tracking those Nasdaq indexes, and also ones powered by Nasdaq Dorsey Wright. And as part of that, she stays up to date on all of the latest ETF trends. I would say both on the advisor side and the retail side. And I always say Jillian truly has her finger on the pulse of the entire industry. And so we're going to have a wide-ranging conversation as well around a number of ETF topics. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. All right, let me now welcome in Travis Spence, Global Head of ETFs at JP Morgan Asset Management, who is joining me from London. Travis, it is so great to reconnect. Welcome to the podcast.
Thank you, Nate. It's really fantastic to be here. I really appreciate you having me on.
All right, so you just heard me rattle off all of those very impressive numbers for JP Morgan ETFs. I mean, you're currently third in inflows this year out of some 270 plus ETF issuers with that $41 billion. You're first in active ETF inflows. You're now the sixth largest ETF issuer overall. And I would say this certainly isn't a new phenomenon, right? JP Morgan's ETF business has been growing for years, but it does seem like there's been some acceleration here. And so to start, I'd love to have you just talk about JP Morgan's positioning in the ETF space right now. We'll get into some specific ETFs, but what do you view as some of the biggest factors driving investor interest right now?
Well, look, thanks for the great introduction. You covered a huge amount of stats, and it's really exciting to be one part of this industry and part of this movement that we're seeing into the active ETF space. But we've got a huge company that is super energized by supporting this part of the investment industry. So I think if you take a step back a little bit and think about some of the drivers for the results that we're seeing, I think one, there's been just a significant pickup in interest around active ETFs, and that's really been over the last couple of years. It's a combination of the convenience of the ETF vehicle with that opportunity to have better investment outcomes. And we're seeing interest from really all investor types. So of course, a big part of the flows are coming in from the IAs and the RIA channels, really the retail side of the market. But equally, we're seeing a big pickup in interest on the institutional side and the asset allocator side, asset managers and other wealth managers. And I think it's pretty remarkable to be in that position of number 3 across the entire industry, including active and passive, when all of our flows in the last 2 years have really been into active. And so that you're just seeing how important the active space is. If you just think about our positioning and how we came into this market, I'll just take a step back, Nate, and explain a little bit more for those who don't know about JP Morgan Asset Management as a firm. So today, we're responsible for about 3.9 trillion in assets. We as a firm have a pure focus on active, and we have about 8,500 people across the world trying to do one thing: manage other people's money and help them achieve their most important financial goals. And we believe that we can have an active edge, an active advantage over the market. So we put a lot of resources into research. We have about 375 research analysts. It actually makes us the largest on the street in terms of commitment into fundamental research. For us, this is a senior role, and people make a career out of research in our firm. And we invest about $1 billion annually in research, risk management, and technology to help support our process. We've got about 1,300 investors across the globe. And one of the things that we try to ensure is that we're bringing those investors together on a disciplined way so that they can share information about what they're seeing across all of their parts of the market. We don't want any of our portfolios being run in a silo. But we're also very focused on innovation. And the client side of our business has an equally important seat at the table within the firm. So to us, that helps to drive a feedback loop with our clients. It helps to drive innovation. And our CEO, George Gatch, always says, innovate, innovate, innovate. We really want to be operating like an underdog in this market and continually looking to do new things. So then if you focus then on what we've done in the ETF industry, we came into the ETF industry about 10 years ago. We launched our first active ETF in 2017. That was JPST in the ultra short bond side. We made 2 decisions early on that I think really has helped to define the business that we have today. The first was we're going to fully focus on active. That's in our DNA, and that's really what we're known for. So we really leaned into that. The second thing we did is to make sure that we were operating this business being fully integrated. So we didn't want to run an ETF business on the side. We wanted to use the same portfolio managers, the same research analysts that have been managing strategies for many years through the cycle, and we brought those into the ETF vehicle. So that was really important because I think that just demonstrates a much longer track record in running many of these strategies that are now available in the ETF wrapper. So as you said, we've brought in about 70 ETFs into the US. 43 of those are active. 75% of our assets are active, but all of the flows that we're seeing are going into active. 41 billion, as you mentioned, relative to last year, we had 45 billion. So we've got 4 months to go. I think much like we're seeing the pace of ETFs across the board, we're probably on course for a record year as well.
All right, so as you go through that, 3 things stuck out to me. Clearly the focus on active management. I would say 2, just leveraging the existing core capabilities of JP Morgan Asset Management, and then this focus on innovation. And I think this all ties together really into this story that we've seen around the growth of active management, particularly in ETFs overall. And I think everyone knows, Travis, this has been a story for several years now. But you look at the inflow numbers into this category, you look at the new launches, this clearly isn't slowing down. And again, as you were touching on, this is a segment that JP Morgan is laser focused on. Like, what do you view as the overarching story here in terms of the investor interest in active management? You talked about, obviously, JP Morgan's focus on it, but what about the investor interest around that? What do you attribute that to?
Yeah, I mean, I think it's investors realizing that there's a vehicle that offers just a lot of benefits. And I know in your show, you talk a lot about those, but the transparency, the extra liquidity, the operational ease, in some cases, the tax advantages as well, all of that just wraps together into a preference for the vehicle. But I think what you're really seeing, and like you said, it's coming out in the flows and the issuance. And we're seeing that across all the investor types that we operate with. Out of that 4.9 trillion, about half we run for end retail channels, so through the financial intermediaries and advisors, and the rest are for big institutional clients and asset managers. And we're just seeing an increased usage across that. Any type of survey that we do, we're also seeing increases in the opportunities that investors are seeing in active ETFs. Let's put some numbers around that. As we know, that's about a 1.2 trillion industry now in the U.S., and we're already at 277 billion for the year. Full year last year was 300 billion, so we're running about 100 billion over last year's trajectory. And I think we'll probably end up over 400 billion this year in the U.S. at active ETFs. It's about 37% of all ETF flows now are going into active. Last year, that was 26%. So again, an acceleration in that. The issuance side is also really interesting. So more than 85% of all ETFs issued this year have been active. We now have more active ETFs in the US than we do passive ETFs. But remember that most of these ETFs are still under 3 years old, because most of this growth has really happened in the last 3 years. Active management, investors generally want to see some track record. They want to see some scale. So I think that's going to be a big driver going forward. As you start to get more track record and scale in the ETFs, you'll see that number tick up. And I think that goes from about 10% of assets today over the next 5 years. That probably doubles. So we'll probably be sitting at about 20% of all assets sitting in active ETFs. That's still a long way to go. You look at the mutual fund industry and about half of the assets sit in active. So I still think that there's a long way for this to catch up. One thing that I want to point out, though, which I don't think is covered as much, is what's happening inside the active ETF flows. So if you think about this year, and we've said, this is really the year for active, and you can just tell, just given how much movement there is in the equity markets as well as fixed income rates, there's a great reason why investors should be thinking about being more active in this kind of a market. But if you go back to the start of the active ETF industry, this really started in some non-traditional sectors. So things like derivative income, ultra short, bonds, and to a limited degree, thematics really started to take off in the active ETF industry. We were a big beneficiary of that. JEPI, JEPQ, as well as JPST, we're part of that movement. And we were early in launching our derivative income, the equity derivative, the premium equity income strategy, JEPI. And then that was in 2020. Then we launched JEPQ in 2022. We've seen that grow to 41 billion on JEPI's side. It's now 28 billion for JEPQ. And JPST stands at the largest fixed income active ETF at 33 billion. So we definitely participated in those. What's been interesting this year is that given the moves in the market and the preference for income, those categories continue to be some of the top categories in net inflows this year. But if you look over the last few years, more than 60%, or actually about 70% of all of the issuance that has happened has been in the traditional core sectors. So think of like your large cap blend or your value or growth, or in the bond space, intermediate bonds and core plus bonds. That's where most of the issuance is going into. And indeed, that's where most of the flows are going into. So derivative income and ultra short and some of the buffer strategies that are out, that represents about 20% of the net flow this year. So, or about 25% of the net flow, Nate. So 75% is going into these traditional core sectors. That's where the mutual fund industry was won or lost. And I think that's where a large majority of flows into the active ETF space are going to continue to go. That's been a big focus for us. So if you think about JP Morgan Asset Management, we are a large core manager. We're present in all of these big categories on both the equity and the fixed income side. And that's what we've been bringing into the active ETF space as we've been launching more of the active ETF strategies. So probably 50% of our flow over the last 2 years, despite the success we've had on JEPI and JEPQ and JPST, 50% of the flows are going into this broader range of these traditional core sector active ETFs.
I'm glad you mentioned that with the traditional core ETFs, because it hopefully this makes sense. A clear trend or theme that I have seen this year is a growing use of active ETFs actually in model portfolios within the core of a portfolio. And I feel like in past years, active ETFs were used a bit more around the edges of a portfolio, but I think there's been a clear shift towards active ETF usage in the core of model portfolios. What are you seeing here, and how does JP Morgan think about model portfolios overall?
Yeah, I mean, I think we see a massive opportunity in model portfolios, and I think that's going to equally mean a boost in active ETFs as well. It's another leg up in the whole story of active ETFs and usage. Some of the data that we look at, Broadridge has come out with estimates of about $8 trillion at the end of April is sitting in model portfolios. They expect that to go to $13 trillion by the end of 2029. Cerulli also has seen higher allocations of active ETFs in model portfolios across the board. We look at some of our own data. We've got a tool that we use called Portfolio Insights, where every year we're analyzing client portfolios. We do more than 60,000 of these portfolios every year. And over the last 2 years, we've seen a pretty significant increase in that data in usage of active ETFs. So about 30% of portfolios. Now it's closer to 60% of portfolios. And interestingly, fixed income, which we think is a massive area for growth, is seeing kind of an outsized usage within model portfolios.
In terms of some specific JP Morgan ETFs, you touched on two of your most popular, which are the JP Morgan Nasdaq Equity Premium Income ETF, ticker JEPQ, and the JP Morgan Equity Premium Income ETF, JEPI. And I feel like, Travis, JP Morgan basically created this category, or at least the interest in this category. Any additional comments you'd like to offer on those two ETFs, or just covered call strategies overall?
Yeah, well, look, I mean, I think in a market like we've been in, downside protection in equities and income continue to be really relevant. And so those strategies sit really, in the center of both of those core investment objectives. We're really proud. I mean, we were early in terms of bringing JEPI into that market. That was early in the development of that category, which today, derivative income is about $120 billion in size. If you include the rest of the buffer type categories or defined outcome, that brings it to about $200 billion in size. We just crossed over a 7-year track record in running that premium equity income strategy. That started in mutual fund format, and we brought that into the ETF in 2020. We're now, when you combine JEPI, JEPQ as a strategy, we're running over $110 billion in that strategy. But again, that has a 7-year track record. So I think it's often, there's a benefit to being early, but I think investors also want to see that proven track record going through cycles. And these strategies have demonstrated that they're providing two things to investors that really has resonated. It's that lower volatility access into the equity market, because at the core of JEPI and JEPQ is an actively managed equity portfolio based on our research that I spoke about before. And then we have that disciplined way of overlaying the covered calls, which is there to produce regular income. Income is our outcome in these strategies. And so I think investors have really, resonated, or it's really resonated with investors that we're doing what we say on the tin with these strategies. But I talked about innovation before, and we don't want to just stop at JEPI and JEPQ. We've continued to broaden that out. In fact, one of the other strategies that we started with even before derivative income was a more explicit and persistent downside protection. And we brought that strategy. We've been running it, same team with Hamilton Reiner and his team, been running that since 2013. We brought that into an ETF called HELO, HELO, which is our hedged equity laddered overlay, which we launched in 2023. That's designed to provide specific downside protection between 5 and 20% downside. You're protected in that strategy. And again, we do that through a series of calls and puts to implement that. But that delivers about a 50% beta to the market. And it keeps investors in the market, which I think is really important with valuations where they are right now. But it's still providing, a level of upside value as well. So that one has also been a really interesting strategy for us. That's almost 3.3 billion strategy today. We've seen almost $1 billion come into that year to date. And so one of the ways that we like to frame that, Nate, is don't say goodbye to your equities, say hello. And we also have the international version, Hola, which we've launched. So we've had some fun with some of the names.
All right, so that's equity income. Let's move over to what I would call more pure fixed income. And I mentioned at the top the two new launches, which have been excellent successes. So the JP Morgan Mortgage-Backed Securities ETF, ticker JMTG, and the JP Morgan Active High Yield ETF, ticker JPHY. And JPHY, if my memory serves me correctly, that launch was something like $2 billion from a large institutional client. I think it was the largest active ETF launch ever. But talk more about just the opportunity in active fixed income. You mentioned that this is massive earlier, and this is clearly a focus with your new launches. And you already had some other very well-known products like we've touched on with something like the JP Morgan Ultra Short Income ETF, ticker JPST. Just talk more about the opportunity here.
Yeah, if you look at the bond market in the U.S., it's about 60 trillion in size. The ETF market today is about 2 trillion in size. And think about the dynamics in fixed income where bond indices are really not meant to be investable. We would go as far as to say, why would you ever want to be investing passively in fixed income? Because it's essentially the representation of the most indebted issuers. It wasn't really designed to be invested. It was designed to be a representation, and then managers have traditionally outperformed that through active management. About 80% of all mutual funds are actively managed, and most of those are able to outperform the benchmarks. But you flip that around in fixed income, and 80% of the fixed income ETFs are passive. And so we think that there's a big imbalance there. And you've seen that in the issuance. Most of the ETFs now being issued are active. We've come out with 14 actively managed ETFs. Today, out of the 3.9 trillion that we run globally in assets under management, 2 trillion sits in fixed income. So we are one of the largest fixed income managers in the asset management space. And we are 100% active in terms of, the focus that we have on fixed income. So we've brought these 14 ETFs, active ETFs, into the U.S. market. We now have, great scale that's being achieved in those. In total, we manage in the U.S. active fixed income ETF space about $68 billion. So it does make us the largest manager of active fixed income ETFs. But we think this is really just the start of this industry. The total active fixed income ETF industry in the U.S. today is about $380 billion. So out of the 2 trillion, it's still roughly 15%. So or roughly 20%. So that's going to be a big opportunity for growth. I think that there's a chance that we see about a 1.5 trillion going into active fixed income ETFs over the next 5 years. And so we're going to continue to put focus there. A couple of the things that you mentioned, I think we do see a preference for the fixed income vehicle or the ETF vehicle in fixed income, and in particular active fixed income. You have some additional benefits because the fixed income markets don't operate as efficiently as equities. So you have high bid offer spreads in some of the sectors like high yield. You've got, because of the way that the secondary market operates in ETFs, you have an additional layer of liquidity that is available for ETFs to tap into. And you can reduce the transaction costs, which can be meaningful because you're using the secondary market for trades. that has less impact on the portfolio. We also can see trades coming in to our strategies on a real-time basis and put those to work in the market, which when spreads and rates are moving around as much as we've seen this year, that can be a big impact to portfolio returns over time. So we just see a lot of additional benefits in the ETF wrapper for fixed income. And that's why we're really excited about this. But that imbalance that you see between passive and active, I think is going to be corrected. I think there's going to be a big preference. And you've seen that in the large institutional client that you mentioned, which is a big relationship that we've had, that looked at this opportunity to add the high yield ETF into what they invest in across the high yield space. And that 2 billion number is a pretty meaningful amount, demonstrating the value that they see in the ETF and having the ETF vehicle available to them. And then we've seen just preference from other investors that, like the JMTG conversion that we did, that was an expression where we know that the underlying clients had a preference for the ETF vehicle. And so we took advantage of that. But we're going to continue to focus on this space. We think it's really exciting, but we just think it's the right way for investors to invest in fixed income, being active. And we see the additional benefits in the ETF vehicle for that investors can take advantage of as well.
Travis, just a few minutes left here. We've obviously been focusing on your ETF lineup, which you've done a fantastic job of, but I would love to hear your views on the markets right now. We don't need to go into great detail here, but I'm just curious, what are maybe 2 or 3 key areas that you think investors should most be paying attention to right now? And you can tie those back into JP Morgan ETFs if you'd like, that's fine. I'm just curious what's most on your radar right now when you look at the current market environment.
Yeah, I mean, it's a very, very relevant question. I think there's 2 things that are on investors' minds. One is the labor markets, because that's the key indicator that the Fed is looking at now in terms of direction of interest rates, and then equity valuations, right, which we know are toppy. And the big question is, can they go higher? What's going to happen with tariffs, et cetera? So I think some kind of 3 takeaways that I would say for investors right now. The first is that rate cuts are real; they're here. We do expect. We think that they're going to be imminent in September. Call it even more of an insurance rate cut. But we're going to continue to look at the labor market. That could delay things maybe a little bit more, but we do feel the direction of travel is 100 to 125 basis points of rate cuts over the next 12 months. So that means investors really need to be focused on the short end of the yield curve, because that's going to move more quickly. The longer end probably stays up a little bit more, but with rates coming down, you're going to have an opportunity for capital gains again in fixed income. So your starting yield, which is a great indicator of returns over the longer run, are in that 5 to 6% range for most of the fixed income strategies that have some duration in them. We've got a number of strategies. As I mentioned, we have 14 active fixed income ETFs, but whether it's J Bond, which is our core bond strategy, or Core Plus, which is JCPB, the high yield strategy, our J Mortgage, which is going to be investment grade but focused on that securitized part of the market. Those are all really attractive places to be right now in terms of capturing that yield and being able to take advantage of rate decreases that are likely to happen over the next year. So I think that's number one. The second is that the AI theme is back. So there's been, some correction in that theme this year. And policy change became the main driver or main focus for investors. We think that that's come back into the main, day-to-day as a driver for U.S. equities. There's going to be continued investment, but it's not just going to be in the tech companies alone. It's going to be in the enablers to AI. And it's also going to be for companies that are taking advantage and being leaders in adoption of technology. That will be a key theme. So in addition to ETFs that we have like JGROW, which is focused on the growth equity side, that now sits at almost $7 billion in assets. And that's been one of our largest net inflows this year, over $2 billion that we've seen come through. That's focused on all of the growth equity sectors. Of course, tech is a big part of that. actively managed, and we've got a great team that sits behind that. There's another one called JTEK, JTEK, that's focused on all of those companies that are either leaders in technology, but more importantly, about 30% of the portfolio is leaders in companies that are taking leadership positions and adopting technology to become leaders in their respective industries. And it goes well outside of technology. So I think that one's been a really interesting one for many investors as well. Again, more than $1 billion that we've seen come in year to date, and the assets in that sit at about $2.2 billion. And then the third theme is flows into international. If you look at the ETF industry to date, a little over $100 billion has gone into international. That's about the same level as we saw last year. And again, we have 4 months to go. I think investors in the middle of the year started waking up to the fact that there is outperformance, but not just outperformance. Looking forward, some of the themes are more persistent. You probably have a weaker dollar. That will benefit some of the international markets, including EM markets. And you have some things that we think are going to be more lasting in support for European equities as well as Japanese equities. So there's been 1,000 basis point difference between U.S. equities and European equities so far this year. That's really, really interesting. Or let's broaden that out. It's more to the international equity side, but that's really compelling. So I think investors are starting to think about, if there's some persistence in these underlying themes, we don't want to be caught off guard, and diversification is going to be a great way to go going forward. So those are really three themes. In the international space, we've got an ETF like Gyre, which is our research enhanced process, but focused on the international side. That's an 8.3 billion ETF. And so really one of the main active ETFs that you can take advantage of to get access to that international market today.
Well, Travis, such a nice tour through the financial markets and the JP Morgan ETF lineup, and congratulations on all of the success you are seeing with that lineup. Again, so great to reconnect. It had been a few months, but thank you for joining me this week.
Great. Thanks for having me, Nate. Pleasure to be here.
That was Travis Spence, Global Head of ETFs at JP Morgan Asset Management.
Trader designs ETFs for sophisticated investors looking for leverage on the daily, monthly, or quarterly performance on stocks and ETFs. Leveraged ETFs involve significant risks. Consider the investment objectives, risks, and charges and expenses of the ETFs carefully before investing. To obtain a prospectus containing this and other important information which should be read carefully before investing, visit our website at traderetfs.com.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
I'm now joined by Jillian DelSignore, Head of Retail and Wealth Distribution Strategy at Nasdaq Indexes. And I will just say, Jillian is someone who I have known for quite a while now. She's a longtime industry veteran. And very simply, she has her finger on the pulse of ETFs as well as anyone, anywhere. One of my favorite people to visit with. And she is now joining me from Chicago. Jillian, it is always a pleasure. So great to have you back on here.
Likewise, I'm so happy to be here. It's great to see you for the first time doing this, when typically we've got it on the phone. So this is really a pleasure.
Yeah, I'm really enjoying this new format because it used to be I couldn't see anybody, and now I can interact, and it just feels a little bit more natural. So look, typically I don't like to start with my guests walking through their job description and what their company does, but I'm not sure everyone is necessarily familiar with Nasdaq Indexes, and maybe how that ties into distribution. So do you mind just explaining this? Like, what do you do every day?
Yeah, absolutely. So as you can appreciate, we offer a whole variety of indexes, right? And there's all different issuers all over the world, literally licensing those indexes. We are very linked in our goal to grow assets in the products that are linked to our indexes. So I and my team, and I have someone in Europe, I have someone in Asia, I have a growing team in the US. We work together with ETF issuers, asset managers in general, because if you think about somewhere like Asia, maybe the ETF wrapper is not the preferred wrapper and it's index fund or separate account. So we work directly with the asset manager to help distribute the product. And what I mean by that is really sort of focus on commercialization. So in the US, we have folks that are out there, forgive the term, wholesaling wholesalers, right? So they are spending time with the salespeople at Invesco, at First Trust, at ProShares, at Neos, right? Talking to them about the Nasdaq index products we have in common, doing events with advisors. We also have the Nasdaq Dorsey Wright team that rolls up under me, and they are actually out there selling in the absence of those ETF issuers, certain products, the Nasdaq Dorsey Wright indexes, and then a certain subset of just general Nasdaq index products. So really, we sit on the same side of the table as the issuer, and our goal is to really help them gather assets and tell the story as much as we possibly can together.
Okay, and so because of the perch that you sit on, as I was noting, you really have to keep your finger on the pulse of everything occurring in ETFs, right? And you clearly do an excellent job of that. And so I thought with our conversation, maybe we should just start a little more broadly here and just talk ETF industry. And so I'll just open this up to you. You know, as you sit back and you look at the world of ETFs right now, what has your attention at the moment, whether on flows or launches, new issuers, anything? Again, I'm just going to give you a blank check here to start our conversation.
Just sort of go, yeah, no. So there's really three things sort of been catching my eye the last month or so, 2 months really for maybe the summer. Although one of the trends goes way much further back than the summer. It's really been three things. If you look at our flows in general, right? The top 4 flow getters across Nasdaq indexes in the Americas: QQQN, QQQ, JEPQ. You just had Travis, so you're going to have Travis on, so certainly JEPQ. And then QQQI, top 4 flow getters. I think that this is insatiable appetite for income, for yield, and these. I know, Nate, I remember hearing you on many a podcast talking about how you thought it was a bubble, right? These the derivatives-based products. Certainly, I think we've all been proven wrong on that one, and that has just been an incredible story. This insatiable appetite, and I think there's just been such an incredible opportunity for those particular products, and you're seeing it with, again, 2 of the top 4. So you combine this sort of desire for yield and income with this desire for the Nasdaq 100, and we're seeing a lot of those products really rise to the top. Something like a QQQI, I mean, that product launched last January in 2024. It's over $4 billion in assets. So there's been really just an incredible story there. So I think that generally speaking, the sort of derivatives-based space, whether you're talking about buffers or this covered call, we're really seeing acceleration in assets on our platform within the index business at Nasdaq there, sort of regardless of issuer. They're seeing a lot of attention paid there. Crypto would be another one of your favorite topics. Clearly, there's certain products that are taking in the lion's share of the assets. I think what's been interesting from our vantage point is something where we're seeing interest in more diversified basket of crypto. So something like the Nasdaq Crypto Index, which as the SEC approves more crypto assets being allowed inside the ETF wrapper, they will make their way into this index. So right now it's Bitcoin and Ethereum, but that will continue to expand. So we're seeing, for those investors who are a bit more, I don't want to use the word hesitant, but just new to crypto as an exposure, it's been a great conversation to have around the index, which allows the index construction to do the work for you. You don't have to make a choice. I want to own this coin or that coin or that coin. The index does it for you. So that's been an interesting story. And lastly, I would say international, right? I think advisors have been woefully underweight to international for the last number of years, and we're seeing a significant uptick in interest and exposure. So if we look at sort of the Nasdaq Dorsey Wright lineup and the conversations they're having with advisors every day, there's been this real interest in even just getting back to neutral. with international exposure. And so that's been the other story that we've been keeping our eye on and increasing conversations with advisors around. It's just this story of, again, just getting back to neutral, not necessarily overweighting, because we're seeing clearly, the Qs continue to just drive so much activity and so many flows within the larger equity space. But as you look at the international space, I think they took in 30% of flows in July, international equity ETFs. They only make up 19% of the assets. So punching above their weight class. And we're seeing that continue as we move through the summer.
I think three really good stories. The crypto story, I'm going to leave that alone because ETF Prime followers' ears are bleeding for me talking about crypto too much. On the international story, just a quick question that I would have for you on that. Clearly, there are some outsized flows. There's interest here. I think there is a lot of positivity moving forward. I completely agree with you that if you look at the average portfolio, whether that's an advisor portfolio or if you go down to the retail level, they are underweight. Do you think that there needs to be longer-term sustained outperformance in order to continue to see that shift? In the ETF space, we always talk about how flows follow performance. I think that's clearly been helpful here, but I feel like investors have been fooled in the past, at least in the recent past, thinking that maybe this is the year for international or that it's really turning, only for it to then underperform. Just any thoughts around that? We don't have to talk specifically about what you think performance is going to be. I'm just curious how close you think that's going to tie into the flows.
I think you're right. I think you're absolutely right. And I think we see that across a lot of different asset classes, but particularly international, where I do think folks have maybe stepped in before and they haven't seen that performance and trying to manage investor expectations on the other end of the advisor, right? So I do think you're going to continue to see that, but the flows are certainly continuing. So we have certainly a huge contingent that's taking the leap, and the performance hopefully will continue to follow that. But the conversations that we're having is really just about this, based on what the client is trying to achieve, of course, as always, but to get a more diversified asset allocation to make sure that they have something a little closer to neutral as it relates to international exposure. And we're certainly starting to see it. And interest around, as Nasdaq Dorsey right, I think those that are followers know sort of the relative strength, momentum-based investing, some of the products we have there, not just developed markets, but also emerging markets. We're starting to see interest there as well, and more of this relative strength, which to your point about performance, I think those particular investors are starting to see that trend and are taking that as a sign.
The other follow-up question I'll offer, and thank you, by the way, for calling out my very poor prediction last year that there was a bubble in covered call ETFs. You're not the first person to tell me how wrong I was on that, so I'm glad that everybody continues to bring that up. But to your point, what's really interesting here is this investor attraction to the Nasdaq plus income. And as you were alluding to, I was visiting earlier with JP Morgan's Travis Spence. Of course, they have JEPQ, and that's had significant interest. And you look at some of these other products out there like QQQI that you mentioned. I could go down the list. There's QILD. You have GPIQ, which is a Goldman Sachs Nasdaq 100 premium income ETF. Just talk a little bit more about this investor attraction to the Nasdaq, but with this added income component.
Absolutely. I think that, when people think about the Nasdaq 100, right? So the innovation, right? They want to be explained to specific companies, part of the Nasdaq 100. And then we're starting to see the Nasdaq 100 use a bit more as core holding, which is certainly something that we have been having a lot of conversations about as well. And using that core of a portfolio to get exposure to innovation, again, these companies listed on NASDAQ. And then this sort of insatiable appetite for the yield component. So this combination of those two things, this real desire for innovation, performance, right? Innovation, exposure to that, and then this income appetite. The marriage between the two has been really attractive, and you're seeing it's really vetting itself out in flows. The thing that I would call out is you are seeing, while it is sort of whole scale across the space, you see firms like JP Morgan and NEOS, which for those that don't know, Next Evolution Option Strategies, right? These are folks that do this, right? And it is what they do. And I think that the education that's being done around this space and those issuers that are providing that education, I think are seeing some outsized flows into their products. And so I do think that as this is a growing space, there is an opportunity for these ETF issuers to be out there and educating investors, advisors on the benefit
of it. And there are nuanced differences between all of them. And so helping investors understand what are the differences and what they should know about these products as they're looking to get invested. So I do think that we're continuing to see those that are really leaning into educating investors and educating advisors are really going to be able to be out there and sort of garnering the assets that follow.
On this topic of income, I know Nasdaq Indexes, along with Wealth Management IQ, they have conducted these surveys of advisors on their use of income products. So I think there was a survey done a couple of years ago, and then there was another one this year, if I'm not mistaken. I'd love to have you perhaps offer a few highlights here, because again, this entire story of investors pursuing income-oriented products, it's been a prominent one. And it's not just covered call ETFs where I have been wrong. It's income really across the board. So, I feel like there's a much bigger story here. Just talk a little bit about that.
Sure. So there were a couple of things that I think really stood out to me as I reviewed the results. And you're right. We did one in 2023 and we did one in 2025. The thing I was bummed about is we did not ask the question about their usage of options-based products 2 years ago, because I'd have loved to see the delta. A quarter of them were using it. Punchline, a part of it, as we continue on that thread. But to take a step back, this was almost 500 advisors that we asked these particular questions about their usage of income broadly, not just ETFs, although we did get into the wrapper as we went through the questions. And so what was interesting to me was that the allocation amount, the percentage that advisors were using in their portfolios really stayed pretty steady, 29% to 30%, right? But I think what really stood out to me is it's really become a core strategic holding. It's become this ballast in the portfolio. It's no longer sort of a satellite to an advisor's portfolio. And they are using it for a variety of reasons, right? Income being one of them, stability being another. But the thing that really stood out to me was a couple things. One, there was a really significant increase into the number of advisors that were looking to ETF issuer salespeople, wholesalers, for thoughts and guidance on what they should be considering. And so for me, it really underscores the importance of that consultative relationship that an issuer, a salesperson has with an advisor. They're really looking for that guidance with the sheer volume of products, even just saying the word income, right? Dividend equities, covered calls, fixed income, so many different things are covered. And so for the advisor to really be seeking the guidance of the ETF issuer salespeople was really stood out for me, and I think emphasized what we're doing here at Nasdaq within my team, and the importance of that and keeping that up, right? Sort of keep doing what we're doing and being that trusted source for the advisor. The other was we saw an uptick, I think it's 2 year over 2 year from 2023 to 2025. We saw an uptick in usage of passive ETFs by 11%. So 11% increase in advisors saying they're using passive ETFs in their portfolios. That to me said, fantastic. ETFs are being used more in different types of exposures, which is an exciting thing for all of us in the ETF industry. The thing that grabbed my eye, maybe even more, was that 9% increase in active mutual fund usage and a 4% increase in active ETF usage. So as I thought about that, I'm thinking, wow, if I'm an ETF issuer and I'm issuing active fixed income or income ETFs, boy, do I have an opportunity to educate some advisors on the benefit of the wrapper. Because if a 9% delta from 2023 to 2025 is using active mutual funds, this drumbeat of nobody's using mutual funds, at least in this audience that we surveyed, it was really interesting. So I think there's a significant opportunity for education around those ETF issuers that are launching active ETFs. Because clearly there's the delta between 2023 and 2025 for active ETFs was 4%, but it's certainly not 9%. So I think there's an opportunity there. So those particular things really caught my eye more than anything.
As you went through that, Jillian, one of the things that it recalled for me is your expertise around distribution, ETF distribution, and you hit on a couple of items there just regarding the wholesaling process and education. I'd love to have you just talk more about distribution more broadly. Again, you're truly an expert in this area, and this basically comes down to how are ETF issuers getting their products in front of investors. And maybe here what I'll do is, again, just give you another blank check. You can go wherever. What are you seeing right now? If we just broaden out in terms of ETF distribution overall, what's working what's not working. The mic is yours.
Yeah, absolutely. So I think as I sort of look at the landscape right now, it's been this fundamental shift where a couple things. This is going to sound interesting for me coming from an advisor background for over 25 years. And I'll talk a little bit in a minute about sort of retail and the importance of retail investors and in the whole picture right now as well. And so as I look at the landscape currently, there's always been this importance of data, right? And you look at the different ETF issuers, and I think they almost have business intelligence teams analyzing data as much as they have a wholesaling force, right? So the importance of not just taking data in from all the different sources, whether it's a home office platform or a data provider, but somebody who's sitting in your firm and taking that data and actually doing something with it. How are you taking this data that you're paying a lot of money for and turning it into insights for your salespeople? And so that's been really critical, and the inclusion and the intersection of just this pure data with AI. And so more predictive analytics as it relates to data for salespeople. So if I'm a salesperson and I'm covering RIAs in Chicago, for me to pull up my CRM any morning and look at Nature AC and see, oh, wow, he recently purchased ABC ETF. He may be inclined to purchase DEF ETF. And so it's using data and AI tools to really enhance the relationship between the salesperson and the financial advisor. And how do we make that a more advantageous engagement? Because as you know better than anybody, you know, your phone's not going to stop ringing, although do people call anymore? Your emails are never going to stop, right? And so the more I can be a valued source, sort of to our earlier conversation, the better. And the more I can use things like predictive analytics and data to help enhance that engagement, the better. So that's sort of one of the things that we're continuing to see. And then sort of this idea of, you know, not necessarily having a traditional model. We have an external and an internal. The more you can use things like data, and you can make a salesperson, you can make their job a bit more seamless and make them more efficient by helping them understand, whether it's through lead generation campaigns where you're only sending the best leads, the most engaged advisors to the salesperson, you know, they can take on a lot more. And so this idea of not traditional external, internal, more hybrid, don't necessarily be in person with financial advisors as much anymore, and being able to accomplish just as much through really effective digital distribution, lead generation, and then turning those leads over to a smaller and mighty sales force. I know you've had our friend Alex from Era Communications on talking about the importance of the digital distribution component, and that certainly ties directly in to the story that we're talking about here. So there's just a couple of things that sort of I'm thinking about and hearing in sort of the marketplace. I think the thing that's a bit more interesting, and as we see more and more active managers come in to the space, as we're seeing obviously in mass, more recently, I think we just saw, you know, some additional managers like Barron's, right, just file, and you're starting to see more and more of the active managers come in, is this ongoing debate of generalist specialist model, right? And so how do you take an existing sales force? How do you incentivize them? How do you educate them to be out there talking about ETFs alongside mutual funds that they're offering to those same advisors? And so it really just depends on the firm that you're talking to, how they decide to sort of slice that up. But that continues to be a topic of conversation amongst distribution professionals around, you know, there's no perfect way to do it. I think it's very firm specific and product specific, but you're seeing it done a whole host of different ways. I do think there's value in a specialist, especially as you're engaging and talking about being a consultant to advisors and having that more specialized conversation around the ETF wrapper and trading, right? That T stands for traded. You need to be out there and having those more specific conversations if I think there's value there. But as these more traditional active managers come in, that's an ongoing conversation that as I'm engaging with some of them, they're trying to square that circle, right? And how do you take an existing sales force and sort of get that right? And how many people do you hire? How do you incentivize? Those sorts of questions.
To your earlier point on data and artificial intelligence, I'll tell you, I won't name the platform, but I actually demoed a platform that is leveraging both of those. And the point of the platform, I'm sure you're familiar with it, is to help ETF issuers or fund companies be able to really target the right advisor. And I bring that up just because I was absolutely blown away by how advanced these platforms are becoming with their use of artificial intelligence, to your point, to really help wholesalers, almost predict allocation decisions and, know what the advisor is going to do and how they're thinking. It truly is unbelievable how fast that space is progressing. I was blown away. The
I think
other
it's
after you go ahead. Yeah, go ahead.
No, I was just going to say, I think one of the things that especially as more of these new issuers come into market, I'm going to mess up the number, but Eric Balchunas mentioned it on a podcast with you. Was it 70 new issuers? I think this year have
This
come in.
year,
Not
yeah,
maybe,
something like that.
yeah,
It's a big number. We're on
70
track for
plus, but
that.
I'm sure it's more by now, right? But I think one of the things is I'm having conversations with some of these people some of these issuers that are new to the space, is this journey to access that an ETF goes on. I think a lot of people are inclined to think, oh, it's an ETF, it trades on exchange, everybody can access it. Not true, right? The first sort of barrier to entry, right, of your product is RIAs. And it's the most accessible to an issuer, but the least scalable, right? And so I think trying to attack that, and it's a very tricky entry point, right? They're very over wholesaled. Again, it's not very scalable, but the other is retail. So I think you're starting to see a lot of the issuers try to figure out ways to access retail specifically, partnerships with the retail brokerage platforms, retail social communities. Think about a social platform focused on retail investing and finance. So we've been working at Nasdaq to really develop those partnerships to help give not just our brand, but the brands of our clients exposure to the retail investor, because that first initial buying community is retail investors and RIAs and some independent broker-dealer platforms. And so I think for the new issuers to really understand that's your market at the onset, and you have to start to gain track record and assets before you start to have conversations with some of the other independent platforms and wirehouses down the line. So the more they can focus their distribution strategy around those markets, the better. And they're both very tricky, which is why it becomes more and more complex, and the need of things like data and things like that to help sort of hone your focus out of the gates.
Jillian, just a few minutes left here before I let you go, and this is unrelated. I wanted to be sure to ask you about the Nasdaq Dorsey Wright platform. So my understanding is there's a full research platform here that I don't think everyone is necessarily familiar with. I know many ETF investors are certainly familiar with the Dorsey Wright name on several ETFs. We talked about that earlier because, again, Dorsey Wright indexes power those ETFs. But talk about this Nasdaq partnership and this research platform.
Absolutely. So many people might not realize that Dorsey Wright Advisors was bought almost a decade ago in 2015. They've been a part of Nasdaq, and they've historically had this research platform, which thousands and thousands of advisors and retail investors, for that matter, utilize daily to help them make allocation decisions, observing relative strength across equities and ETFs, other investments, accessing model portfolios. But in the last couple of months, really about 3 months ago, if my memory is serving me, we actually launched a free version of that Nasdaq Dorsey Wright research platform. It doesn't come with the full firepower, as you would imagine, but not everybody necessarily needs the full firepower, right? And they may just want to be out there exploring what we have to offer by way of some of the research that we provide, ongoing daily research, I should say, on our relative value momentum-based investing and the products that follow, to your point, the indexes that they have. And so this free platform, Nasdaq Dorsey Wright Foundations, is accessible to all who want to be able to observe some of that research that we make available. The other thing that's really exciting is those model portfolios that used to be behind a paywall are now outside of that paywall. So to the degree you're looking for model portfolios that you might want to start looking at for your clients, those are now available for you to look at, hundreds of models, some that are attached to very large ETF issuers, others that are just that Dorsey Wright puts together themselves. So would encourage those advisors that are interested in learning more to go and visit the Nasdaq Dorsey Wright Foundation's platform to take a look. We'll also be at Future Proof. Nate, I know we'll be missing you, but we'll be out there and certainly be able to talk much more about that here in 2 weeks. Hard to believe. But that's what I think. Again, there's a big following of Nasdaq Dorsey Wright that's out there, and I don't know that everybody is aware that we've made part of that platform free for all advisors to access.
And is that accessible through the NASDAQ.com website, or is there a separate
Nasdaq
URL
Dorsey
or portal?
Wright's website?
Okay.
Yeah, the Nasdaq Dorsey Wright website. You can go ahead and find the foundation and set the free version there. Give it a try. You can do a free trial of the paid version if you want to for a couple of weeks, but it certainly brings, again, there's a lot of noise out there for advisors who are trying to sift through everything available to them. And so I think anything you can provide by way of education is certainly welcome. And so that's what we're trying to do.
Well, Jillian, excellent insight this week. No surprise at all. Again, I always love connecting. Thank you for joining me.
Thank you, Nick, for having me.
That was Jillian DelSignore, Head of Retail and Wealth Distribution Strategy at Nasdaq Indexes. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I will be joined by Alex Morris, CEO of FM Investments. So they have a couple of very interesting new launches that are bond ETFs seeking to avoid dividends or the interest from the underlying holdings, which are other bond ETFs. Essentially, I would call these highly tax-efficient bond ETFs. We'll explain all of this in detail. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.